Let's talk to one of my firm favourites. His name is David Harris, and he's the CEO of InvaTrust Consultancy Ltd. Happy New Year to you, young David.
Thank you very much. It's a bit late for Happy New Year, but well, I know you'll say it's me who's been away.
Exactly. Yeah. Right, I said, somebody approached me in a pub recently and said, Moose, I've got £50,000 to invest, and I said that would be a good topic for some consideration, a pub chatter, and you've made some notes, okay? Perhaps you'd run through some ideas for people to consider. We're not giving strict investment advice, okay? They've got to go away and do their own homework. But
So sitting where we are today, I looked and sort of thought, well, there's sort of four possible portfolios you could have. You could have one on yield, one on growth, one aggressive, and one defensive. So we'll do yield and growth today, and then we'll come back and visit
part two.
Defensive aggressive. Yeah. So looking at a yield portfolio to start with, FTSE yielding, let's say, I don't know, 3.2, 3.3. Yep. You can do better than that, and a yield investor is going to want to do better than that. So I came up with 4 or 5 ideas. Let's say if you've got your £50,000, put 10,000 in each. Now, you may argue 5 stocks is too few, so you may want to find 10 stocks like this. So it depends on your attitude to risk. So my 5 that I came across: Standard Life Aberdeen, recent merger, not wholly positive news. I mean, they lost the Lloyds Asset Management mandate. Can it deliver on its promised £250 million worth of expenditure cuts? Who knows? However, the merger does bring with it a sort of much needed scale and financial cost savings, and I'm not as concerned as many. I think there's a great upside potential from the current share price as the merger matures, and you're looking at a yield currently of in excess of 5%.
Okay, so that's worth considering.
United Utilities, they deal with water and waste management up in the northwest. It's reporting growth in revenue, profitability. There's uncertainty about regulatory charges within the utilities industry, and also any price caps this government may want to put on, although quite what the common sense is in putting price caps on energy, I haven't quite worked out personally. But again, a yield in excess of 5%, and that's forecast to grow by at least RPI over the next 2 to 3 years. Utilico Emerging Markets Trust was my third choice. Now, this is not, I suppose, too dissimilar to United Utilities, except that it targets dividend-paying companies in the emerging markets. Right. So small water companies, electrical companies out there in the big wide world, overlooked by a lot of people. Volatility, yes, because of that, but geographical spread you've got. That offers you a current yield of about 3.5.
Okay, like that.
You've got Aviva, UK life insurer. A lot of publicity recently because it was going to, or threatened to, buy back all of its preference shares, which irritated anybody over 65 who's in there on a very, very good yield. But they've gone back on that. But overall, ignore that for a minute. Good, solid company, and I think there's quite a bit to go with the price, as well as also a solid dividend yield. And the final one in the yield portfolio I've chosen was Barratt Developments. Now, UK house builders not in favour. You're looking probably 9-10% down from where they were at their peak. But we're going to have to keep building houses. The government wants more social housing built. Not absolutely sure where the plumbers and the bricklayers are coming from to do that. But Barratt's will benefit from that, and in the meantime, you've got a subdued share price and you've got a sensible yield of about 4.5%. So that's the sort of companies, have a spread. That little portfolio I've given you would give you overall a 5% yield.
Very good.
And I think that somebody who's in retirement looking for that would be happy with that.
Okay. So the part two,
Part two. Going growth.
Yep.
Now, I've put a couple of small caps in here, the first one being InvaTrust Asset Management, one of the smaller asset management companies. It's had a very, very good record over the last 5 years. It runs a series of funds globally. Revenue growth predicted to continue to increase, good management and a good yield. And I see no reason at all why InvaTrust shouldn't grow and therefore the share price grow with it. My second choice was Lloyds Bank. You know, the banks, we all know the story of the banks for the last 10 years, but they're still there. Balance sheets are a lot better. And going forward, there's no reason to suspect that we won't see a great deal of growth in the share price of a number of banks.
And they're yielding 4% as well, aren't
Yielding
they?
4%, exactly. So
Okay.
you've got a bit of yield. You could actually switch that over into the yield portfolio if you wanted
Yep.
to as well.
Okay.
Diageo, another one that's down about 8 or 9% from its peak. But Diageo sells what you and I buy, as in alcohol.
Right. Well, beer, my favourite subject.
But it sells over 200 different products in 180 different countries. So
it is a world-class
it's a
leader, isn't it? And a
world-class
name.
World-class name. And I see no reason at all why that recent fall in share price shouldn't be reversed. And also, going forward, there's no reason why Diageo won't grow and the share price grow with it.
Okay, very good.
Fourth choice, which many people may not have heard of, is Baidu. Baidu is a Chinese internet search engine. It's not as big as some of its other competitors out in China, like Tencent, but its aim is to be one of the global leaders in artificial intelligence, AI. Now, I know a lot of people say, oh, technology, look where it's come in the last 10 years. And they're suspicious and they think there's going to be a big fall. My argument to that would be balderdash, or a word very similar to that, that if you were to invest today, where is technology going to be in 10 years' time? And I think it's going to be a lot higher, and companies like Baidu, I believe, are going to be at the forefront.
Understood. Very good. So like that.
And the final one is Costains, another one that's pretty much in the sort of construction, house building, infrastructure area, but it uses a lot of technology-based engineering in order to get results within that energy and infrastructure world. Its recent trading statement has been very good. There are expectations that it will continue to grow. It's on a PE of about 13, and it also is paying a yield of about 3%. So again, you could argue that there's a sort of income oblique growth story for there. So those are the sorts of companies, slightly smaller maybe than others would like.
Yep.
But I see there's potential there, and going back to your conversation with Justin Urquhart-Stewart last week of bear markets, with all of these, be prepared to sell and come back at a later stage. You know, we won't get all of these correct. You won't get, I mean, if you do, then you're a better man than I am.
You run your winners, don't you?
Of course you do. Of course you do. And you get out, but you don't get out overnight totally into cash. And you don't all of a sudden have a fairy godmother that taps you on the shoulder and says, now's the time to invest.
Yep.
So these are the types of things you have to do, and review them regularly.
David, on that note, great to see you. Thank you very much indeed.
Pleasure.